When the market goes up, you go up. When the market goes down, you don't go down. Safe Money Radio, your money safe and sound.
Welcome to Safe Money Radio with your host, Brad Pistole. Brad is a retirement and income specialist, primarily serving Springfield, but he's sought after nationally for his expertise in helping people secure their retirements. Mr. Pistole is a licensed life insurance professional in the states of Missouri, Arkansas, and Kansas, and he specializes in working with people who are near retirement and those who have already retired with wealth management, income planning, and asset protection strategies.
Safe Money Radio, your money safe and sound.
And now, here to talk with you about securing your retirement, your host, Brad Pistole.
Well, hello everyone. Thank you so much for joining us today on Safe Money Radio. And if this is your first time to ever hear us on the radio, or maybe you're listening to the podcast, we just want to welcome you to the show. I've been hosting Safe Money Radio for almost 16 years now, and I will tell you, it is our passion to get information out to our listeners to educate them regarding their retirement accounts, their IRAs, their 401ks, their 403bs, their TSPs, really focusing in on and specializing on tax-deferred accounts, because those are things that people just don't know a lot about. They own a majority of their money inside these accounts, but they don't know a lot about the tax rules and the distribution rules and how those things are going to pass on to their heirs, to their spouses and their non-spouses, like their children and grandchildren. And this is what we really focus on this show. And today's show is going to be very unique. I really am going to be talking about something that just happened to me this very day when I walked into my own bank. So I want you to stay with us, because if you think the bank is where you need to go to talk to a trusted financial person, you're going to second guess yourself after listening to this show. The one thing I've always said on this show for more than 15 years now is, you may not like what I have to say, especially if you're another financial professional or if you're someone who doesn't represent or sell the type of things that I represent and set up for our clients. You probably don't like what I have to say because you don't have that arrow in your quiver. But I will tell you this, whether you like it or not, I will tell the truth. And it is the truth regarding what's happening in this world, what's happening in this country, and what's happening in regard to financial planning and the taxes that are involved. We're going to be talking a lot about taxes today. The title of the show is IRAs, RMDs, RBDs, and so much more. So let's get ready to have some fun with all this Congress and IRA and technical terminology. Buckle your seatbelt, because your head's probably going to spin at some point in the show. But trust me on this, my friends, if you own tax-deferred accounts, you need to know the information that we're going to be talking about on today's show. Remember that you can always call us 866-780-SAFE. That's 866-780-7233. So let's jump right in. You know, I've had a home for sale for several months, and I had more than 50 showings, and this is really an indictment on what's going on in the economy and what's going on with homes. But with more than 50 showings, I went under contract twice. It fell through both times. I really thought, you know what, I may not sell this home before the election. But thankfully, by the grace of God, someone walked in, the right buyer, offered the right amount of money, and said, cash deal, close in 2 weeks. And finally, I was able to sell my home. Now, here's the thing with this. The home was titled in the name of my trust, my revocable living trust. And so my real estate agent said, hey, by the way, we need to make sure that you've got a bank account set up in the name of your trust, and because you're going to be paid out to the trust, and we need to make sure that you're able to cash that check and get it deposited. And so that was all good information. And I walked into my bank, my local bank, and just so you know, this information is shared with permission, as all of my stories are. And I will tell you, just for protection of the bank, because I'm certainly not trying to say something bad about the bank. They're my bank, and I love the people who are there, but I have money at 4 different banks, so no one knows which one I'm talking about. But here's the thing. I walked in to talk to them about my trust, and while I was there, and this happens almost every single time, the person working on my situation said, hey, come into my office for a minute. And I went in there, and they said, can I ask you a couple of questions? And I said, sure. And they said, well, what do you think's going on in the economy right now? Are we about to go through a crash? Are we about to go through a downturn? And this is, of course, a banker who's talking to me about all things financial. And as we got to talking more and more, I realized that they had some issues in their own personal life and things that they were talking about, whether or not they should upsize in a home and move from a 2.75% interest rate to a nearly 8% interest rate, and what that would do to their payments and what that would do long term, and whether or not that would be a good move. And all those things are important, and they were talking to me about all of it. But this is the part that I got to share with you today. They said, Brad, when it comes to IRAs and things like this, we had someone come in this week who asked us about moving their deceased husband's IRA into their own IRA, and they said, I know I can do this, but I need you to help me retitle that IRA. And he said, these things terrify us because we don't have an IRA specialist here at the bank. There's not anyone who knows these rules and these laws, and so we're just kind of guessing, and it just makes us really nervous. Well, there's a major red flag. And here's the thing, friends. That's the truth, and I appreciate them sharing the truth, but you have someone helping you who does not know what they're doing. So if you think you're going to go into the bank and talk to them about your IRA and think that they're specialists regarding that, you need to think again. You need to think many times over and over again, because not only are banks not IRA specialists, Ed Slott, America's IRA expert, will say that 99% of financial advisors are not IRA experts. Why? Because they just specialize in investments. They want to talk to you about stocks, bonds, mutual funds, or anything like this, gold, silver, real estate, whatever, but they don't have any specialized training when it comes to IRAs or 401ks or tax-deferred accounts. Their specialized training is getting you to trust them to put your money into the type of account they want you in so that they can earn their commissions and their salaries and their fees to pay all their bills for the rest of their life, right? They don't have specialization in telling you how to get the money back out of those accounts in the most tax-efficient way. When you do that, if they're your advisor for 15, 20, 30 years, when it comes to taking distributions and you want to talk to them about tax planning, they're going to tell you, you need to go talk to your CPA. Is your banker, is your financial advisor, is your CPA a trained IRA expert? Have you ever asked that question? Have you ever gone in and said, hey, do you do any specialized training in IRAs or tax-deferred accounts? Because you have my IRA and my tax-deferred accounts. If their head spins or if they get that deer in the headlights look and they say, well, sure, then you need to say, can I see the manual from your most recent conference that you've attended regarding IRAs? Because, friends, here's the thing. In parts 2 and 3 of the show today, I'm going to be sharing information with you about a new article that's titled Untangling the IRS's New Finalized Regulations on RMDs, Required Minimum Distributions, the 10-year rule, trust beneficiaries, spousal beneficiaries, annuities, and more. There is some major stuff changing right now through Congress regarding IRAs, distributions to spouses and non-spouses, and you need to know this information. Is your current financial professional trained in this regard? Are you going to the bank and talking to them about your IRA? Are you talking to your CPA about it, just assuming that they know the right laws? Because, friends, I'm telling you, 99% of them do not. They are not trained specialists. Friends, if you've listened to this show for years, you know this. If you're listening for the first time, I will tell you, I am a retirement income certified professional through the American College of Financial Services, and I am an Ed Slott Master Elite IRA Advisor. I'm one of the longest-standing members of his group. I've worked with the Ed Slott Group since late 2009, early 2010, for more than 15 years. It is absolutely imperative, if you have your money saved in tax-deferred accounts, like IRAs, 401ks, TSPs, 403bs, you need to be working with someone who's not only trained in how to get your money into an account, but how to get the money back out of the account in the most tax-efficient way. Friends, I wrote a #1 best-selling book about this. The title is Bulletproof, The Safe and Secure Retirement Income Plan. And I talk about the taxes that exist inside your tax-deferred accounts and how to get that money back out. My good friend and CPA, Ed Slott, wrote the foreword to the book. If you would like to read a copy of the book, or if you would like a free financial consultation from an expert regarding tax law and tax-deferred accounts, call us anytime. Our number is 866-780-SAFE. That's 866-780-7233, and there's always someone standing by to take your call. Now, friends, on the show today, if you're just joining us, you want to go back and listen to the first part of the show. And if you're listening on the radio and you just turn the channel and you're like, well, how do I go back? Just go to YouTube, type in Brad Pistole, Safe Money Radio. You'll be able to subscribe to the podcast, and you can pause, rewind, listen to this show as many times as you would like to, because I'm telling you, there is critical retirement planning information being shared, not only on this show, but every single week on this show. We are the go-to retirement income certified professionals in this area, and we share information with people all across the world. So, friends, let's go back to the story at the beginning of the show. I walked into the bank to do some work on my living trust account there, and the IRA topic came up with the banker, and they said, I've got to tell you about this situation because I just didn't know what to do. Someone came in, their spouse had died, they wanted to move their IRA into their own name, and I didn't know what to tell them. I didn't know if they could. I'm not an IRA specialist. We don't have an IRA specialist at the bank. What should I have done in that situation? And so this is what I said. I said, well, buckle your seatbelt. I don't want your head to spin, but it totally, completely depends on the age of the person who died, on the age of the spouse who's still alive, and all kinds of other situations. So just off the top of my head, I said, let me give you an example. If the person who died was 74 and the spouse was 67, then here's the thing. That spouse who had the IRA who died had already reached their RBD, required beginning date, meaning they had passed the age of required minimum distributions, which is age 73 for a current 74-year-old. I said, if that person leaves the IRA in the name of the decedent, the spouse who has passed, they will have to continue taking required minimum distributions every year, even though they're only 67 years old. So in that case, depending upon other situations that we would need to find out by talking to the client, they might want to roll that IRA over into their own name. That way, I said, as Uncle Sam looks at it, it's like that spouse never existed. Only a spouse can roll over an IRA into their own name. So she would take her husband's IRA, roll it into her name, and now because she's 67, she would not have required minimum distributions until she reached her required beginning date, the year of her RMD. Is your head spinning yet? But I said, listen, the situations get much, much trickier than that. Let's take the same situation and say he was 74 when he died, but the spouse was 54. And friends, that happens more and more and more in today's world, right? He's 20 years older than her. He dies and she comes in and says, hey, I've heard a spouse can do a rollover and roll the IRA over into their own name, so I want to roll the IRA over into my name. Should she do it at age 54? Well, a lot of people say, well, of course you should. Just roll it over into your name. But here's the problem. Once she rolls that IRA over into her name at age 54, remember, Uncle Sam looks at it like he never existed. So now that IRA is hers. And what are the laws regarding distributions from an IRA when you're under the age of 59 and a half? That's right, friends. There is a 10% federal penalty on all distributions. So if she takes that and puts it in her own name to make it easier and cleaner and to have his name off of it, then she just penalized herself. Because from age 54 all the way to age 59 and a half, now she cannot take distributions from her own IRA without a 10% federal penalty. So in that case, in that specific circumstance, she should have left the money in the name of the decedent, in the name of her spouse, until she reaches age 59 and a half. And then after she's reached age 59 and a half, she can then do the rollover into her own name. Here's a great rule until Congress changes it. There is no time limitation on a spouse being able to do a rollover of their spouse's IRA into their own name. She could do it 5 years later, 10 years later, 20 years later. But she would need good advice from an expert in IRA and tax-deferred accounts telling her, look, based on your situation and your age, you don't want to roll this over into your own name or you're going to have a 10% penalty for the next 5 and 6 years on your distributions. Of course, by this time, the banker's head is just spinning, and it made him think. He goes, my dad's got an IRA, and we inherited money from a sibling or one of his siblings, and I'm the one that's the trustee, and I'm managing this money. And I was told by the advisor, because I have money invested with this advisor too, and they're my dad's advisor, I was told that when I inherit this money from my dad when he passes, I should just cash it out. There's something about this new 10-year rule, which we're going to talk about in the next segment of the show. And he said, with that 10-year rule, the advisor told me it's the easiest thing to do and the best thing to do to just cash it out in year one and be done with that. And I looked at him and had this look on my face, and he said, what? And I said, well, let me just tell you, you need to write my name down, which you know my name. I've got accounts here, obviously, but write this down, go to YouTube, type in Brad Pistole, and go watch all my videos, because the advice that advisor gave you is some of the worst advice I've ever heard, and I hear bad advice every day. And he goes, that's not what I wanted to hear, and I was afraid of this. So he said, why is that? And I said, well, listen, let's just say you inherit your father's IRA when you're 40 years old, okay? And let's say for easy numbers, there's $100,000 left in that account, and it's a tax-deferred IRA, which you're saying he owns. If you, by the advice of your advisor, just take it and cash that out, you're going to add $100,000 into your earned income for that year on top of your salary and on top of your wife's salary, and that's going to take you from whatever tax bracket you're in, let's say you're in a 12% bracket, to maybe a 24% bracket for that year. And you're going to give 12% to Uncle Sam for no reason. You just lit fire to it and gave him 12%. So $12,000 on $100,000. I said, or you could take a distribution once per year for the next 10 years, keep yourself in the same tax bracket and pay 12% instead of 24%, and liquidate this over time, and have found a way to give yourself a pay increase every single year by taking a distribution out of this account. Let's say it was $10,000 a year. And he said, oh my goodness, how do I learn all this confusing stuff? And I said, well, number one, you need to be working with a financial professional who's a trained IRA expert. You're talking to one sitting across the table from you right now. It's very clear the person you're working with right now is not a trained expert, or they would not have advised you to cash out an IRA as a non-spouse beneficiary. So he said, I'm going to watch your videos today. I'm going to start going through them and watching them. And friends, if you're listening right now, you might find yourself in a similar situation. Perhaps you've been given some bad advice. Maybe you were given the bad advice and learned the hard way. You took the advice, you cashed something out, you made a decision, and then you didn't know and didn't learn until the year ended, and you got a 1099 on a distribution you didn't know you were going to get, and there was no way to undo that tax problem. This is why we invite you to go to our website, guaranteedsafemoney.com, to go to YouTube and look up Brad Pistole, Safe Money Radio, subscribe to the podcast, watch our videos with our key retirement planning experts, and stay in tune and in touch with those who know what they're talking about. Friends, our number is 866-780-SAFE. That's 866-780-7233. And in our next segment, we're going to be talking about some hot off-the-press information that you need to know regarding the Secure Act and how that's changed rules and laws regarding distributions, required minimum distributions, spousal and non-spousal beneficiary information. So our number is 866-780-7233, and we want you to stay with us for the rest of today's show. Friends, if you're just now joining us, we've been talking about something that happened when I just walked into the bank on a random day in the middle of the week to go in and do something on one of my accounts. And the banker who was there, who's a great individual, just started talking to me about IRAs and how the bank does not have any IRA specialists there, and they get asked IRA questions all the time, and that makes them nervous and uncomfortable, and they don't know what to say. And that led into them telling me about their own specific situation in which they were advised by their current advisor that when their father passes, that they should just take their tax-deferred distribution and cash it out. Because there's this new 10-year rule for non-spouse beneficiaries, and he said, you don't want to mess with that. You need to just cash it out and be done with it. Well, friends, I'm going to be sharing something with you today from 3 absolute experts. Michael Kitces is the main author of this information I'm going to share. He's connected to the American College of Financial Services. If you look him up, he's all over YouTube. He's all over LinkedIn. He is a retirement income specialist, a guru. And also going to be talking some of the information shared from Jeffrey Levine, who's also a CPA, CFP, and he is a retirement planning expert. Now, to go back to the last segment, I want to share with this. Remember, this individual was told by their advisor, if your father dies and you are a non-spouse beneficiary, you should just cash it out. Avoid the 10-year rule, just cash it out. This is in this article, Untangling the IRS's New Finalized Regulations on RMDs, the 10-year rule, trust beneficiaries, spousal beneficiaries, annuities, and more. This is what it says. Listen, and I quote, just because a client doesn't have to take a distribution this year doesn't mean they shouldn't. Many beneficiaries subject to the 10-year rule are best served by spreading the income from their inherited accounts out over as many years as possible in an effort to avoid a much larger spike in income and tax rates in a future year. Now, friends, that's exactly what I said to this client. Here's why you don't want to just cash it out. You'll be taking all that income. That could be $100,000, $200,000. In this case, it was more than that. $300,000, $400,000, $500,000. Adding that into your earned income for the year on top of you and your spouse, throwing yourself into potentially the highest tax bracket there is, and giving all that free money to Uncle Sam when you could have taken it as a 10-year payout, keeping yourself in a much lower tax bracket. And that's why this stuff is so important. So, friends, I have in front of me something right now called the IRA Beneficiary Family Tree. This is something that Michael Kitces just created. He put out there for financial professionals to use and to see because this stuff can be so confusing. And I realize this. I realize that 99% of you listening right now, your head is about to spin a 360. But this is the only way I know to share with you just how important this information is. My good friend Ed Slott, CPA, IRA expert, America's IRA expert, says this: when someone dies, touch nothing. Why is that? Because if you touch something, the fat lady sings, it's game over. 1099s are going to come your way. Don't touch anything until you go talk to a certified financial professional, not just your average advisor on every street corner, not the bank, not your CPA. Make sure they've got credentials as an IRA or tax-deferred specialist, and here's why. IRA beneficiaries fall into several different categories now in 2024 and beyond. They fall into designated beneficiaries and non-designated beneficiaries. Now, when it comes to designated beneficiaries, there's 2 types. There are eligible designated beneficiaries and non-eligible designated beneficiaries. Are you spinning yet? Here's the thing. An eligible designated beneficiary are people like surviving spouses, disabled persons up to a certain age, chronically ill persons, persons 10 years younger than the decedent, minor children, some see-through trust benefiting the persons named above. Non-eligible designated beneficiaries are most non-spouse beneficiaries. That would be people like your children and your grandchildren. Also includes some see-through trusts and that benefit people named above. Those are just your 2 different types of designated beneficiaries, eligible designated beneficiaries and non-eligible designated beneficiaries. And guess what? Those 2 different types of beneficiaries each have their own specific rules regarding how and when they have to take their distributions. When it comes to eligible designated beneficiaries, it depends. Did the person who owned the IRA die before their RBD or after? Now, what's an RBD? Don't confuse this with an RMD. An RMD is a required minimum distribution. And a required minimum distribution has to be taken after the RBD, the required beginning date. And yes, Uncle Sam keeps up with when the original account holder died and whether or not they had passed their RBD, their required beginning date. And your distributions as an eligible designated beneficiary or a non-eligible designated beneficiary are completely dictated by whether or not that person has reached their RBD, their required beginning date. Now, this may mean that they're going to get a 10-year stretch rule. This may mean that there's a 10-year only rule. It may be a 10-year rule and a stretch opportunity. And friends, then we have this whole other category of something called non-designated beneficiaries, and that's when a trust or an estate inherits the IRA, something without a living, breathing pulse. They have totally different rules. They have a 5-year rule if the person died before their RBD, and they can stretch over the decedent's life if the person died after their RBD. Now, before we run out of time for this part of the segment and before your head explodes, let me ask you a question. Was any of this confusing? Is there any of this that made you want to say, stop talking, Brad, I don't want to hear any more of this. This is too confusing. How in the world could I, as a consumer, how in the world would I possibly know all this stuff? I just know that I got told when I started my job to contribute to a 401k, and I did that. And I don't really know what it's invested in. I don't really know how it works, but I know that from time to time I've had to take a distribution, and when I did, they took 20% of my money, and there's taxes, and there's rules, and there's penalties. So I have no choice but to just go trust someone. And friends, that's my whole point on today's show. You do have to go trust someone. Ed Slott says we live in a yo-yo economy. That means you're on your own. But in the you're on your own world, you better be working with someone you trust. You go to a doctor for your health. You go to a dentist for your teeth. You should go to an IRA specialist for your tax-deferred accounts. You don't just walk up to anyone and go, hey, clean my teeth, whether you have any training or not, or just because they put something on the label of their shirt saying, I can clean teeth. You want to make sure they've been through the right training, graduated from the right schools, and they know what they're doing. Friends, I am a retirement income certified professional through the American College of Financial Services, and I'm an Ed Slott Master Lead IRA Advisor. I've been working with this specialized group of 400-plus advisors from all across the country for 15 years now, and we focus on these type of accounts. Give us a call for a free financial review. Our number is 866-780-7233. We will give you a copy of my free best-selling book, Bulletproof: The Safe and Secure Retirement Income Plan, and I will meet with you absolutely free to make sure you're headed in the right direction. 866-780-7233. There's always someone standing by to take your call. Now, friends, if you're joining us on the show today, you're just now joining us, it's a heavy show. There's a lot of stuff that we're talking about. We're talking about IRAs, RMDs, and RBDs. So let me just get your attention from the very beginning. How many of you own an IRA? If you're listening out there right now, you're on the radio. Now, if you're driving, don't raise your hand. But if you're sitting on your couch watching the podcast or listening, if you own an IRA, just raise your hand. Yeah, that's me. Hey, Brad, I own an IRA. How about a 401k? How about a 403b or a TSP? Okay, you own a tax-deferred account. So let's go back to IRA because that's the most common account. If you've had money in a 401k before and you ever left employment and moved it, even though you still call it your 401k, it's no longer a 401k. It's no longer governed by ERISA. It is now an IRA. When you move it out of the 401k, it's an IRA. So here's the thing. What do most financial professionals and most average people think IRA stands for? Individual Retirement Account. I will never forget, ever forget, more than 10 years ago when there was this keynote speaker at an event, and he had all these slides, this fancy PowerPoint behind him, and he was going through the slides about IRAs and talking about all these rules, and he kept saying, your individual retirement account, your individual retirement account. And so I didn't want to create a mess, and I wasn't trying to embarrass him, but he had just put a slide up on the screen that was taken as a picture straight off of IRS.gov. And it was about IRAs and the rules that govern IRAs. And so I just raised my hand and said, hey, I said, I just want to point out one thing. I do always tell my clients, and this is a really powerful thing, that when they have an IRA, they don't have an individual retirement account because that's not what IRA stands for. And he looked at me like, what in the world are you talking about? I've been presenting nationally and publicly for many years. IRA absolutely stands for individual retirement account. And he said, I'm sorry, I'm confused. What do you mean? I mean, IRA stands for individual retirement account. I said, no, sir. It doesn't. I said, would you please go back one slide on your screen? And he was confused, and he went back one slide. And right there on the screen in front of hundreds of people, IRA from the IRS.gov website said IRAs, individual retirement arrangements. It's right there, friends. In his own PowerPoint, while he was presenting to all these financial professionals, he had been sharing information that was wrong for years and years and years. That's why Ed Slott says 99% of all financial professionals don't know what they're talking about, because someone gave them the wrong information and they just keep repeating it, even when they read it on their own slides that they prepared over and over again. Now, this person was a good friend of mine. I wasn't trying to embarrass him. I said, listen, this is a great moment. None of us are in front of clients right now. We're all financial professionals, but here's the key and the power to this. Remember, there's a lot more power in understanding an IRA is not an individual retirement account. It's an individual retirement arrangement. And what is the arrangement? The arrangement is that Uncle Sam put you in handcuffs the day you started that 401k or that IRA or that TSP or that 403b, because here's the thing. They all have rules regarding required minimum distributions and required beginning dates and having to take the money back out and having to pay taxes when Uncle Sam says you have to pay them. And when you agreed to open that account, he slapped the handcuffs on your wrist and said, I've got you. Now I'm a co-owner of your account, a joint owner, and a beneficiary. And if you don't know the laws and the rules regarding these accounts, I might even be your primary beneficiary. Oh, sure, I realize you might put your children's names on your beneficiary form, but don't ever forget, friends, if you're listening right now on the radio or to the podcast, don't ever forget, if it's a tax-deferred account, the names that you see listed on your beneficiary form are not the only people who are your beneficiaries. Uncle Sam is your silent partner. Remember, when distributions come out, either taken by you or taken by your spouse or taken by your non-spouse beneficiaries, your children and grandchildren, siblings, whoever it is you leave it to, unless it is a charity, Uncle Sam is a silent partner. And he will only be silent until you take the distribution. And then he will speak up with a megahorn, and he will say, remember me? I'm your partner, Uncle Sam, and I get to tell you how much federal and state tax you have to take out. And not just today, but if you're a non-spouse beneficiary, you have to take these distributions out for the rest of your life or the next 10 years or the next 5 years, whatever the entity is, the individual is who is the beneficiary of that account. Uncle Sam is right there dictating all the rules. And don't ever forget, he's one of the beneficiaries. And if your children take the money out, let's use an example, you leave them $500,000, and your child says, oh, Dad left me money, $500,000, write me a check. And they write them a check from that IRA account. That child will add that money into their own earned income and to their spouse's earned income if they're married, and that could take them from a 10% bracket to a 39% bracket. Or hang on a second, let's not forget, we're $35 trillion in debt right now, friends. It might be that by the time your children inherit that money from you, the highest tax bracket might be 50%. Or 70%, or dare I say it, the highest the federal tax bracket's ever been, 94%. Don't believe me? Go back and look up 1944 and 1945. The highest federal tax bracket was 94%. If you've been to see the new Ronald Reagan movie, they quote Ronald Reagan when he talks about having to pay 94% in taxes. So, at what point will your spouse or non-spouse beneficiaries inherit your IRA or your tax-deferred account? What will the tax brackets be at that time? Will your non-spouse beneficiary, your children and grandchildren that you love so much, will they know the laws that govern those accounts? Will they know not to just cash it out, putting themselves into the highest tax bracket and making Uncle Sam the primary beneficiary of your account? Friends, if you think this stuff isn't important, you need to stay with us on today's show. We're going to be talking about untangling the IRS's new finalized regulations on RMDs, the 10-year rule, trust beneficiaries, spousal beneficiaries, and much, much more. This is critically important stuff. Remember, one of my primary influences in my life is America's IRA expert, Ed Slott. He is a genius regarding tax planning and financial planning and tax-deferred accounts. And he says this: it's not what you make, it's what you keep after taxes that counts. Friends, the majority of you listening right now have your money saved in tax-deferred accounts. I know this because I meet with people all across the country every single day, and they have 401ks and IRAs and TSPs and 403bs. And here's the thing. Are you working with a retirement income certified professional who is highly trained regarding how to get the money back out of the account in the most tax-efficient way? I am an RICP, and I'm an Ed Slott Master Lead IRA Advisor, and I have been for more than 15 years. Our number is 866-780-SAFE. That's 866-780-7233. There's always someone standing by to take your call. They will schedule a free financial consultation. You can bring your statements in. We can sit down and look at what your current plan is and find out whether or not you have loopholes in that plan that could turn into major tax issues on down the road. Our number is 866-780-7233. Call us anytime. We're here to help. Friends, on today's show, we've been talking about this new article that just came out in 2024, untangling the IRS's new finalized regulations on RMDs, the 10-year rule, trust beneficiaries, spousal beneficiaries, annuities, and more. And here's what I want to do in this segment. I want to read part of this to you just so that you can understand just how complicated this can be. Here's what it says. When the original Secure Act was passed in December of 2019, it brought sweeping changes to the post-death tax treatment of qualified retirement accounts. One of the biggest changes was to eliminate the prior stretch treatment of post-death distributions for most non-spouse beneficiaries who are now subject to the so-called 10-year rule requiring beneficiaries to fully distribute inherited retirement accounts by the end of the 10th year following the original account owner's death. In early 2022, when the IRS issued its initial proposed regulations regarding the Secure Act's provisions, it included another bombshell. Not only would so-called non-eligible designated beneficiaries be subject to the 10-year rule, but if the original account owner had been subject to RMDs, required minimum distributions, prior to their death, the beneficiary would also need to take annual RMDs throughout that 10-year period, in addition to fully distributing the account by the end of the 10th year. Now, in its new final regulations issued on July the 18th, 2024, the IRS has confirmed the requirement for non-eligible designated beneficiaries to take RMDs annually. Although for beneficiaries who would have been required to take RMDs in 2021 through 2024 but didn't, the IRS has confirmed that there will not be any penalty and no requirement to make up the missed distribution, meaning the new regulation effectively starts with RMDs that are required to be taken in 2025. Is your head spinning yet? I'll keep going. Beyond the confirmation of the general post-death RMD rules, the 260-page final regulations document offers a slew of other regulatory guidance for specific circumstances where the new rules for eligible and non-eligible designated beneficiaries apply. Now, friends, listen closely. These include new rules for handling undistributed RMDs in the year of an account owner's death, a new hypothetical RMD rule for surviving spouses who initially elect to use the 10-year rule but later choose to roll over or treat the inherited IRA as their own. Specification that when a plan participant has 100% of their plan balance in a designated Roth account, Any non-eligible designated beneficiaries are not required to take annual RMDs during the period of the 10-year rule. Here's another one. Clarification of the requirements for successor beneficiaries who, depending on their circumstances, may need to either begin a new 10-year period after which the account must be fully distributed or finish out the original beneficiary's 10-year period. New definitions of which beneficiaries of a see-through trust are also considered beneficiaries of the retirement account and which may be disregarded for retirement account purposes. Here's another one. A new rule providing that when a see-through trust is divided into separate trusts for each beneficiary upon the death of the retirement account owner, the RMD rules will be applied individually for each trust beneficiary rather than uniformly across all beneficiaries based on the beneficiary with the shortest required distribution timeline. And finally, clarification that when a retirement account, including IRAs, owns both annuity and non-annuity assets, those assets can be aggregated together for the purposes of calculating that participant's RMD, and that payments from the annuity can be counted against the total RMD for both annuity and non-annuity assets. Now, friends, along with the new finalized regulations, the IRS also released a new set of proposed regulations dealing with some unanswered questions around the Secure Act 2.0 that was passed in late 2022. Most notably, the new proposed regulations confirm that the RMD age for individuals born in 1959 is 73. Since a drafting error in the final regulation inadvertently set that RMD age to 73 and 75. That's right, Congress made a mistake and had to correct it. And it fills in the rules around the Secure Act's new provision allowing surviving spouses of retirement account owners to elect to be treated as the decedent for RMD purposes. Although, as the proposed regulations make clear, the treatment for surviving spouses won't really be identical to the decedent's, since the surviving spouse must still calculate RMD based on their own life expectancy, and none of their own beneficiaries will qualify as eligible designated beneficiaries. As a whole, these regulations introduce significantly more complexity to the process of tax planning around retirement accounts, particularly after the death of the account owner's original owner, which makes it all the more valuable for financial advisors to get familiar with the new rules and their planning implications for different circumstances, since clients will be more reliant on sound advice to give them clarity and to help them avoid pitfalls when deciding what to do. Now, friends, I know this. I've been to Ed Slott meetings for 15 years, and I've seen when the newbies show up, they show up for their first meeting ever, and Ed and Sarah and Ian and Andy get up and talk, and about 30 minutes later, I'll look around, and the newbies are sitting there drooling, and their eyes look like a deer in the headlights, and they're like, whoa, slow down. This is like drinking from a fire hydrant. And guess what? They're the people who actually took the time and the expense and the dedication to pay into their own education to learn the information. And they're overwhelmed. Imagine the advisors who never go to anything like that. All they do is get their license to sell you stuff, and they do. They sell you stocks, bonds, and mutual funds, but they never get any specialized training regarding the type of rules and information I just read to you. If you ever go in and want to talk to them about your 401k or your IRA or your stocks, your bonds, your mutual funds, and because it's in a tax-deferred account, you say, well, what about when I die and I pass this to my spouse or I pass this to my grandchild? What about the rules? They're not going to know the rules. Are you kidding me? If they listen to this show right now, their head would spin. They would not know this information. And they will tell you, you need to go see your CPA. I'm not a tax planner. I'm just a financial advisor. I sell stocks, bonds, and mutual funds. Friends, I believe that you want someone who does both, who does all of the above, who knows all these special rules, who takes the time to go study and train to know the information that they need to know to not only help you get your money into the accounts, but to also help you get your money back out in the most tax-efficient way. Because when the money comes out of the tax-deferred account is when Uncle Sam wins. He hopes you never learn these rules. He hopes you do not know these laws. He hopes your advisor, your CPA, your banker does not know, and 99% of the time they don't. So just like the person from earlier in the show today was giving the advice, when your father dies, just cash that in. Don't mess with that 10-year rule. Cash it in and be done with it. That would have been a major financial mistake and a major tax planning mistake for that individual and for their family. We keep our clients from ever making mistakes like this. That's why I've been training with Ed Slott, America's IRA expert, for more than 15 years now. That's why he wrote the foreword to my book, Bulletproof, The Safe and Secure Retirement Income Plan. Friends, stay with us. We got one more segment. We're going to wrap this all up. We're going to tie this all together. But know this, our number is 866-780-SAFE. That's 866-780-7233. Call us. Sit down with us. We'll give you a free financial consultation, and we will get you moving on the road to safety, preservation, guaranteed lifetime income, and making sure you keep all of your money in your pocket, not in Uncle Sam's. Our number is 866-780-7233, and there's someone standing by right now to take your call. Friends, on today's show, we've been talking about a whirlwind of different things. We've been talking about the IRA beneficiary family tree. We've been talking about all these newfangled rules from Congress about designated beneficiaries. There are eligible designated beneficiaries. There are non-eligible designated beneficiaries. There are non-designated beneficiaries. And each one of them has their own group of people who fall into them. And each one of them has to follow the rules regarding the distributions from your accounts. So that brings up this question as we close today. If you own a retirement account and it is tax-deferred, meaning it is an IRA, it is a 403B, it's a TSP, a thrift savings plan, or it is any other type of tax-deferred account, do you have a plan for the distributions from that account while you're alive and the distributions from that account after you die? Do you know with absolute certainty that your financial professional or CPA is a trained expert regarding those distributions? Do you know that Uncle Sam is a silent partner on your account? And even though you don't have him named on your beneficiary form, he is one of the beneficiaries. If you have 3 children, there are at least 4 beneficiaries. Uncle Sam's the 4th one. Here's the question. How much will he get? Well, that depends on your beneficiaries. If one of your children decides they're going to take that distribution over 10 years and they add that income in as 1/10 at a time until the 10th year, he may get a lot less from that account. In fact, he will. But if one of your children says, hey, write me a check, I want all of it right now, then he just made Uncle Sam a much bigger beneficiary of your retirement account than you thought, because they'll add all that money and that earned income into their account all in 1 year, and they will also add that into the spouse's MAGI, modified adjusted gross income, and Uncle Sam will get more of that piece of pie. So this is where I believe the term rolling over in the grave comes from. You think you have a trusted advisor, you think you've set up this great plan for distributing your money, then you pass away, all that money's tax deferred from your 401k or your IRA, and then the money passes to your spouse or to your non-spouse, your children and your grandchildren or a sibling or a friend, and you find out from the grave that they took it out in the worst way possible because of bad advice they were given from your financial professional, and Uncle Sam reached up and said, thank you very much. I'm not only a beneficiary, I was only going to get a 1/4, but now I'm going to get a 1/2 because they took it out in the wrong way. They didn't know the rules, and so that makes me win, and so does the state. Remember, feds and state will both get part of that tax piece of pie, unless you live in one of the very few states that don't have state income tax. Friends, this information is very, very important. That's why America's IRA expert Ed Slott says this: it's not what you make, it's what you keep after taxes that counts. It doesn't matter if your return's 15, 20, 30%. If you turn around and give Uncle Sam back 15, 20, 30, 50% of it back, then you didn't make anything. You need to make sure that you're talking to someone who has a plan for taxes. Maybe we need to talk about paying taxes now while they're on sale, doing Roth conversions, getting rid of Uncle Sam and making him be removed as a partner and as a beneficiary on your retirement accounts forever. I can show you exactly how to do that and whether or not it's in your best interest to do it. I can show you how to put your money into things that will forever leave Uncle Sam on the bench. I am a retirement income certified professional. I don't have any debt. I'm blessed to be a multi-millionaire. I don't have to worry about my income, and that's a great thing. But here's the thing. I'm a real millionaire, friends. I've kept Uncle Sam on the bench where he belongs. I have ponied up and paid the taxes now up front at today's rate to get rid of him so that the money I make in my accounts is really my money. It's real money. If you don't understand the difference, then you just need to do a little bit of homework. Take someone who has $1 million in a tax-deferred account like an IRA or a 401k and someone who has $1 million in a tax-free account like a Roth. And then if you don't think Uncle Sam's important as a beneficiary, just try liquidating that account. Just if it's yours, take all $1 million out. Guess how much you'll keep? You won't keep much. 50% or more is going to go to Uncle Sam. But if a person who's a true millionaire who takes a distribution of all $1 million from a tax-free account, guess what? All $1 million belongs to them and to their family because Uncle Sam has been removed as a joint owner and a joint beneficiary. Friends, make sure you're working with a retirement income certified professional who has skin in the game, who's done these things for themselves, who owns the type of accounts he's telling you to own, who has a 15, 16-year track record of owning these accounts, knowing these tax laws, and planning for the financial future. Remember, it is not what you make, it's what you keep after taxes that counts. Call us. We are the premier financial planning experts in Springfield, Missouri, and all over the United States. Friends, we have clients in North Carolina, South Carolina, Florida, Tennessee, Texas, Oklahoma, Arkansas, Missouri, Iowa, Kansas, Arizona, you name it, it keeps going and on and on and on. Because people all over the world realize that their professional has never talked to them these things with them. And they want to talk to someone who is a highly trained individual regarding retirement income planning and taxes. Our number is 866-780-7233. Call us, request a free copy of my best-selling book, Bulletproof, The Safe and Secure Retirement Income Plan, and I will give you a copy of my Safe Money Kit, absolutely free. Look us up on YouTube or on Spotify or on Apple, wherever you get your podcast. Just look up Brad Pistole, Safe Money Radio, and don't miss one single episode. Friends, our number is 866-780-7233. There's always someone standing by to take your call. Well, I'm about out of time, and I would like to thank you for listening to Safe Money Radio. If you're serious about your financial future, give me a call, and together we'll get your retirement savings on the fast track to accumulation while reducing exposure to market losses. Thanks for listening, and until next time at the same time, I'm Brad Pistole, reminding you to stay safe so you can step into a secure future.
Save Money Radio, your money safe and sound.
You've been listening to Safe Money Radio with your host, Brad Pistole. Find out how to contractually guarantee that your hard-earned money is safe while avoiding market loss so you can have the retirement that you deserve. Call Brad Pistole now for your complimentary Safe Money book and Safe Money information kit at 866-780-SAFE. That's 866-780-7233.
Save Money Radio, your money safe and sound.
The preceding information does not represent tax, legal, or investment advice. Surrender charges apply to base contracts. Optional lifetime income benefit riders are used to calculate lifetime payments only and are not available for cash surrender or in a death benefit unless specified in the annuity contract. Fees may apply. Guarantees are based on the financial strength and claims-paying ability of the insurance company. No information presented today should be acted upon without meeting with a qualified and licensed professional. Obviously, by calling us now, you are just taking the first step towards protecting your retirement. It's important that you read all insurance contract disclosures carefully before making a purchase decision. Rates and returns mentioned on this program are subject to change without notice.